All in favor, say aye.
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 It's been a while.
Opposed?
Any opposed?
Any opposed?
Nay.
No.
Motion carried.
Motion carried. We'll move
Give
on
him
to
the
the,
words, and he's gonna pick it up.
yeah. We'll move on to February 9th meeting, 2024, which was a special meeting. What, before we, I understand that we really weren't needed there. What, can somebody give us kind of a quick summary on what that meeting was about?
Sure, yeah, so the city manager wanted an actuarial cost study of changing the normal retirement to a 20 and out, 20 years of credited service regardless of age for all police officers. And in order for the city to utilize the board's actuary, Foster and Foster, the board needed to approve authorizing their actuary to do the study. And so Dylan called the special meeting. We just needed a quorum, so I'll be honest, I started making calls. I got 3 people and I stopped, and then I
Didn't need
sent an
any more?
email to the
Okay.
rest, and I really hope I didn't make anyone feel left out. But this was something that, you know, the city manager really wanted done, and so we were kind of expediting it. Patrick is working on the study. I'm not sure if it's been delivered or not, but that was the reason for the meeting, and it was a quick one.
And the city's paying for the cost of the study. so-
Okay, yeah, then there was no,
Yeah,
yeah.
But there were no alternate options. Is that correct?
well, that's what, you mean the 20 now?
Yes, to the
Well,
20,
that's
there were
that's
no,
what the city wanted to do, and obviously they had to go, the union had to agree with it, but, yeah, that's what the city wanted to do, and I suspect the union would probably be okay with it, and so then they can move forward.
there's no consideration for pay raises.
That could be negotiated.
It's completely separate.
Well, the whole purpose, if I understand correctly, was to retain people. Well, part of retention is benefits. So pay comes in there right away. So it shouldn't be separate.
Fortunately, that's not within our jurisdiction, that's between the union and the city.
Yeah, we just,
If you remember from when we were there, this was the city manager's request to
Right.
advance this one portion of what they had discussed, I assume.
It is one
Didn't come out of-
component.
So just one component, he needed us to approve
Okay.
it before they
Yeah,
could move
So
forward.
they could get the actuary to do the study and find out what it would cost. That's
And that's
really
why
what
we
it was.
approved it.
But the city manager's only approaching it from one aspect, and that's the
No,
20
that's
years.
the only thing that they needed our approval of.
Right.
We don't know what else they're
Okay,
doing.
got it. Okay, I'm with you. Okay. So we're obviously going to vote no, right? I'm kidding.
This is just about approving minutes at this point.
yeah, yeah. So they're just getting rid of the age of 45, right? Is that really what am I understanding?
No, it's going from 25 to 20, isn't it?
25 to 20.
Yeah. So instead of 25
Now you
years
can
of
leave
service,
with
you get 20.
25 years of service, or normal retirement. And if this gets adopted, you'll be able to leave with 20 years of service,
Oh,
normal
okay.
retirement.
And they're hoping that will help with retention, because
Yeah.
you can get out earlier.
That's
at full
fine.
retirement.
It shouldn't have much of any kind of effect on our pension.
Oh, it would.
Why?
Oh, yeah.
Because they're gonna
Letting
be-
somebody go
they're
5 years
pulled out
earlier? Yep. Yeah, it'll have a cost. But that's what the actuary's doing.
Yeah,
And the
it'll
city's
be-
gonna pay the cost, so, you know, we as a board have done what we can do.
Yeah, yeah,
We
yeah.
let them use our actuary.
I don't think it'll be,
That's all we can really do.
I'm just curious,
If
it's
I-
fine.
If I understand everything correctly, we're trying to do this to retain people, so they don't come here and get some training, then go somewhere else. Okay,
Sorry, that
That's
was loud.
probably what they're thinking, yes.
and that's the alternative that I was referring to.
Okay. So we're just, anybody want to move to approve the minutes? I wasn't here, so I can't approve the minutes.
Yeah, you can.
You do have to vote,
Oh, okay.
but he can't make the motion, correct?
Well, we probably could, but, did somebody make a motion to approve it?
So then one of us who was there has to.
Doesn't matter.
All right,
Anybody can make the
I
motion.
move to approve the minutes.
Anyone second?
Yeah, I'll second.
Okay. And all in favor, say
favor?
aye.
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 Opposed?
Oppose? No? Okay, the motion's approved. Move on to the next item. New business, election of officers.
Sorry, I should know better. Okay. So every 2 years, in accordance with your operating rules, you are to select or reselect the same officers. Currently, Dylan Renz is your chairman, Sam Kibbers is the vice chair, and Chris Salzman is the secretary. someone can make a motion to change that up in some way, shape, or form, or you could always vote to keep the current officers for another term. I'll leave that up to you guys, but those are the current positions.
I'll move the same slate.
I'll second that.
All right, all those in favor, say aye.
Aye.
All those opposed, say no. Hearing no dissent, the motion is approved. I get my annual raise, right, for that?
We're gonna double it.
Double my pay?
Yep.
Yeah,
Just like last year.
that's good. Reports, attorney and consultants, ANCO Consulting, Carrie?
Thank you very much. Jorge and I are actually going to split today. I'm going to handle the performance piece, and then he's going to talk to you about the, kind of continue the fixed income discussion from last quarter. And if it's all right with you, I'll also have him do the Mariner piece because he's more eloquent in the delivery than I am. So I will start with your 1231 books, just kind of getting into performance there. There's a letter kind of in the very front of your book from Mike Welker, and just in summary, it says, we added 5 new partners, and obviously it talks about the Mariner acquisition as well, so we will get into that later in our portion of the agenda today. But on behalf of Mike, I always want to say thank you for the business. We don't take you all for granted at all, very much appreciate working with you. I think getting into kind of the market commentary and the backdrop for the period ended December 31st. In your bigger of the two kind of green books, the 1231 book on page 5, our kind of typical market charts begin there. And if we look on page 5 at that top right chart, you can see really all the indices very strongly positive across public markets for the period ended December 31st. So S&P up just shy of 12%, mid and small caps up kind of even more than that, kind of 13 to 14% within the U.S. And I think what you're seeing there is, markets feeling very good about the fact that the economy's been very resilient in the face of the rate hikes that we got from the Fed in 2022 and the first half of 2023. We were very well telegraphed to see a recession. However, the labor market remained very healthy. Inflation data is coming down. We're still not at the 2% where the Fed wants us to be, but we're certainly much closer, kind of hovering around 3 than we were not long ago when CPI was at a 9% increase year over year. So inflation data, looking much better again. Strong labor market, good GDP numbers, consumers still spending, and I think that's what you're seeing coming through within domestic equity for that period to end December 31st. Even overseas markets were pretty strongly positive in the middle in gray. You can see the all country was up about 10%, developed markets up pretty much in line with that, and even emerging markets up about 8%. And then in the bottom segment of the top right chart in green, the fixed income benchmarks, you can see the aggregate returned almost 7% for the quarter, which actually brought fixed income positive for all of 2023. We were slightly negative going into October, but there was quite a bit of rate volatility through the quarter. Rates kind of peaked in October, and then as the Fed kind of shifted their narrative, they kind of came back down. So you saw the 5-year go from a peak of about 5% to finish the year actually down about 380 to a 388. So quite a bit of rate volatility there just over the last couple months. But anyway, we ended in a little bit of a lower position, which is what gave us kind of that pop within fixed income there for the quarter. And then on the 1 year, as I mentioned, all of calendar 2023 was really very good for public market kind of stocks and bonds. On the 1 year, the S&P up more than 25%. Mid and small caps up kind of mid to high teens. Overseas markets up kind of in the mid to high teens as well. And as I mentioned, fixed income positive about 5.5% on the ag for the full year of 2023. So excellent year for public market performance. Obviously, we're coming out of what was a very challenging period in 2022. So we certainly put together a pretty good year kind of in following up to that and ending 2023. I think kind of getting into your pension itself, flipping to 14 in your books, we'll take that kind of high-level view of where the assets are and what the values are.
Carrie, where are you again?
14, it's kind of the colored pie charts with the banners at the top that give you the asset values for the pension. And looking at the top there, you can see we started the quarter with a market value for your pension just a hair under $22 million. We ended slightly north of 24.5 million, so very nice earnings there for the quarter, as I mentioned. Looking at your kind of different asset classes, domestic equity was about 55.5% of your pension. International equity was right about 14%. Domestic fixed income just over 27. A little bit of global fixed, a little more than 1.5% there. And then a little bit of cash on hand as well for benefits and expenses. And if we flip from there just a couple of pages to 16, it's a little bit easier to see kind of where you're overweight and underweight. And in summary, you are within your investment policy parameters, that kind of plus 5%, over or under that we give ourselves. You can see domestic equity's a little over about 3%. Global fixed is under about a little over 3%. But again, well within those investment policy parameters. Not a big surprise because domestic equity has been on such a tear. When we need cash for your fund, we always do pull your current allocation. So that's kind of a natural rebalancing there. So we are comfortable with where you are at this point in time from an asset allocation standpoint. And then just flipping to 19 in your books, from a performance standpoint, excellent quarter and really 1 year as well. So there on 19, you can see, both gross and net, you were up just about 10.4% for the quarter. The index overall was up about 10. Within the equity segment, so overseas plus US, just south of 12%, the overall index up about 11.5. So as I mentioned, very strong US domestic equity results up over 12. International not far behind, that segment was up almost 11 over the index, which was closer to 10. On the active side, WCM, kind of that growth orientation, kind of in particular, some of the themes were, luxury goods makers, kind of that semiconductor AI theme were very strong. So you see WCM up almost 12%. And of course, you've got the index piece in there too, which was up almost 10 there. Within fixed income on the next page, overall, that segment was up about 7.5%. Slightly over the index, which was up about 7. So as you all know, Garcia Hamilton is that interest rate timing manager. They'll kind of move around the curve based on what they're seeing from macro data. And because rates did come down some, they were up north of 7.5% over the ag, which was up about 6.8 there for the quarter. Within global, still good absolute returns. That fund was up about 6.5. But with that kind of Bloomberg Global Aggregate, that's going to have some U.S. in it. The international fund is not going to, and so that was a little bit of a drag there. But really, all in all, excellent quarter, and you can see the ranks, being up almost 10.5%. For the quarter, again, you're in kind of the 17% range for the full year, so really excellent results for the period ended 12/31.
Do you think that one of the, it's pretty good, right? 5 percentile for the
Yes.
1 year, 56, I'm not sure what. But if you even look at the 56, if you look at the all public plans fund total median for the 3 year, we're only not even 20 basis points off. So we're right on the nose even with that.
Yep.
And then the 5 year, obviously the 22 percentile is pretty good. I know that real estate really struggled.
Yes.
And you think that's one of the reasons why maybe some of the other plans had real estate in them?
Absolutely,
And
yeah.
they really
If you're
took a
looking at
dive
it,
and
that's right.
we were not in real estate, so.
Yep, the drawdown in real estate over the last several quarters is totaling about 17 to 18%. So yes,
Yeah.
not being in that space has been a huge help for you guys.
Yeah. We still have real estate, but it's in the Vanguard Index Fund. But
Yeah.
it's not overweighted in our portfolio with additional funds. So.
Right, that's right. And then just flipping ahead to the February flash as well, equity markets have continued to be very strong. I think, again, the fundamentals are good and the Fed keeps wanting to try to talk about cutting rates, but the data's just really not justifying it. Markets still very strong in February. You got over 3% just for the month. And that puts you at the fiscal at about 14.5%.
Gary, you're in the other book now, right? The little
Yes, I
book?
am, yes,
Yeah.
the
Yeah, you
skinnier
changed,
flash.
and everybody's trying to find it
Gotcha.
in the big book.
So kind of fast forwarding
book.
to the other book again in that February flash. February was a very good month. You picked up a little bit north of another 3% there. And as I mentioned, that puts you on the fiscal up about 14.5. So really good place to be as we approach kind of the halfway mark of your fiscal. Very happy for you all in that regard. We will talk in a little more detail again about that fixed income piece But I think, other than that discussion, everything's going very well in the portfolio. And happy to answer any questions you might have.
Should I go over the SPIVA report now? Is that a good time?
Feel free, yeah.
Is that all right? Is that okay, everybody? To go over the thing that I brought? I think it's, we're talking
Based on our
about
other comments, it probably makes the most sense now.
Yeah, I
It's
mean,
more-
it kinda
most
fits in.
relatable.
Yeah,
So-
before we kind of transition away
Yeah.
from kind of general portfolio, yeah.
So I brought to the presentation, there's 4 pages. There's 2 pages in front and back. I don't know if everybody's got a copy or not. If not, you might want to share it with somebody. This is the S&P Dow Jones indices. I think everybody's seen this. I bring this about once a year. It's the annual report. It's the S&P Index versus Active. That's what SPIVA stands for. And they do it twice a year, but I just bring it in once a year. I went ahead and highlighted this, which just came out in March. If you look at the second paragraph on the first page, it kind of just tells you that, why do we have, I'm going to reinforce, why do we have passive Vanguard fund, right? And the reason why is because these funds have just outperformed most active funds, almost certainly in the short run, but certainly even more so in the long run. And so you can see here, but last year about 60% of all funds underperformed the S&P 500 for large funds. And you can see going back, I put a little arrow there to show that. And the average is about 63%. So you might say, well, that's not much. But if you go to the second page and you look again, you can see that also international, 74% of the funds underperformed indexing, which is why we use international indexing. And as you go further into these, there's the 1 year, the 5 year, and the 15 year, and eventually no funds outperform. Active funds outperform indexes the farther you go out. And we can go into great detail, and if you want to talk to me individually about that, I can kind of explain the way it is. But at the 15, you can see at the bottom of the paragraph, at the 15-year horizon, in all asset classes, that's stocks and fixed income, there were no categories in which the majority of active managers outperformed. Now, this page reports 30-plus pages long, so I didn't print it out, but I went ahead and took page out 11, which is on the next page. And you can kind of see Report 1B, and this is a risk-adjusted return. So they make sure that they take into account the type of risk these companies take, and I kind of put a box around it. So you can see, let's just take the 5-year, where 90%, this is all domestic funds, so the S&P Composite, which is 1,500 stocks, 90% of all active funds underperform the index, and as you go into the 10-year, it gets to 95%, and then it kind of levels off at the 20-year at 96%. So in the end, really, to try to, I can understand with individuals to try and, they want to speculate, they might want to try to outperform the market and do such things, but we're a public pension, and so our job is to, not take any unnecessary risk. So let's say we really roll the dice and we make an extra couple percentages here or there. Well, it doesn't really matter because this pension will be around 30, 40, 50, 100 years. So even if why take the risk to get a couple extra percentage when we could easily underperform the market just as much? And once you get behind, it's hard to get caught up. So I just want to reinforce the reason why we have just one fund that basically encompasses almost our entire equity. If we go to the next page, you can see this is for benchmarks for fixed income. And I highlighted the investment grade intermediate funds, which is the Bloomberg aggregate, which I think is, would you agree, is probably the closest to our Garcia and Hamilton fixed income, the ag?
The ag is the fund category that they're comparing the ag to. I think there's a flaw in their selection there because they're comparing investment grade intermediate funds that have a duration of about 4 to the ag, which has a duration of over 6.
Yeah.
You obviously can get much more favorable results when you do that, but that's a methodology thing. We'll kind of get into some other benchmarking, but by all means,
Okay.
we're equity asset classes still very much.
So you can kind of see over the 5 years that 56% underperform. 10 years it goes to 77%, and then the 15-year. But if you want to go to the other categories too, I thought it was interesting. The second one down is government funds. 1 to 10 years, almost 100% of the funds underperformed over 15 years, which is very surprising. And it's also for emerging market debt. I don't know what's going on with New York. 100% of their funds underperformed. So just, I'd like to everybody keep this in mind when we're trying to pick, if we're gonna pick active funds, more often than not, we're gonna probably underperform the index. And as we go into this discussion, just thought this would be a relative thing to talk about. Does anybody have any questions on this? Anybody wants me to, I can email them the entire report if they want to go read all 32 pages of it. But anyway, thank you for your time. And this, one other thing, I think we can kind of see this strategy playing out, right? If we look at our investment performance and how we're doing versus all the other funds, we're in the top, over the last 5 years, we're in the top 22%, right? The strategy is working, certainly in the fiscal year to date, in the 1 year. Thank you, everybody.
I think there's, definitely from a lot of the data we just saw from S&P, obviously index providers, and just kind of the overall evolution of the marketplace. They call it the Vanguard effect, right, for a reason, right? The low cost indexing and the impact that has on the broader industry is a real thing, and it's had incredible effects for how people access particularly domestic equity markets, but even international equity markets, and it's just consistently very, very difficult to provide excess returns. Now, we were almost talking about this with another manager, but in a post-2000 world, essentially, where friction barriers to entry have come down, democratization of the markets have become much more accessible to a broader set of the population, those opportunities for excess return have become very, very, very small. So it's much harder for active managers to really outperform the index for a lot of those other reasons, and you're seeing that play out in the equity performance. So very much in agreement, and you see in structures now, particularly in the equity space, a very high preference toward using and at least anchoring in index funds, or going all exclusively index funds, and those tend to do pretty well and tend to rank pretty high consistently overall. So I think it just reinforces.
Do you see that changing in the future, or is it going to be stabilized pretty much where it is right now?
I think it's going to be stable. Some people say, oh, indexing just exacerbates these moves underlying, and they're kind of breaking the valuation metrics of a lot of individual stocks, and I don't particularly agree with that. I think that they magnify it a little bit, but they magnify it on the downside as well, and I don't think that they're significantly, because all these flows are coming into index funds, that they're shifting the valuations in any kind of negative way. There's still a lot of other active participants in the market that are forcing valuations and price discovery overall. And if you think about index funds and how they're used, these aren't active investors, right? Every 2 weeks, when your paycheck comes out, yes, they might get some inflows into the index funds, but you don't see a big movement in overall prices when you see those kinds of inflows. So I think that argument overall obviously is given by active managers because they want you to give them a shot at outperforming again, but it's really hard. And the ones that do outperform, it's really hard to distinguish whether that's skill or luck, right? But it does go into the fixed income, why we're talking about fixed income today. And I think why we're talking about fixed income today, not only in the context of active passive, but also in Garcia Hamilton as a fund itself. So there's been some frustrations with kind of the roller coaster that is Garcia Hamilton. And I think a good page to show that, if we stay on the big book before we go into the fixed income book, but if we stay with the 1231 performance book, and you go to page 22 of that report, you'll see second line from the bottom of that page. This is calendar year, fiscal year performance for Garcia Hamilton. And we just go left to right. It was bottom quartile, then it was top decile, then it was bottom quartile, then middle of the pack, then bottom quartile, then top decile. It's all over the place. And for a performance monitor, for an investment consultant, for a committee, it's difficult to go through that. And it's because there are a couple different elements to fixed income, right? There's yield, how much yield you're getting, what the security selection is, how much maturity risk you're taking, and they tend to be very active in how they move around. But the more they shift around gives them more opportunities to be wrong about things or mistime things, and that's why you see this roller coaster. So over time, while yes, they've done okay, you're experiencing a lot of volatility from a manager that really touts themselves to be a high-quality manager overall, and a manager that focuses on quality and consistency. We're not really getting that consistency. So obviously that's been a running theme from some of the meetings we've had and some feedback, and you're not the only board, by the way, that this has come up in lots of other boards, so you're not the only ones going through this kind of analysis now given the most recent results. So that brings us now to the fixed income analysis package, and there's a couple pages on the front end just about the fixed income marketplace overall, but the first page, page 2 there, with the big pie chart on the right, just shows you what the index looks like. This is the Barclays Ag Index, the traditional aggregate bond index. You can see it's 41% treasuries, another 5% government related, so all in all, 46, almost 50% of this is government, and part of those MBSs are agencies, so about 50% government issued. Now, remember that in the equity indexes, the best names lead the indexes, right? The equity indexes are dominated, typically they're cap weighted, so you have the Apples and Microsofts, right? The higher value of a company you are, the bigger part of that index you are. In the fixed income world, it's the more debt you issue, the bigger part of that index you are. So unsurprisingly, the government issues a lot of debt, which is why they make up 50% of the index. And even in a lot of the corporate sector, right, security selection becomes important because companies that issue a lot of debt, right, all companies issue debt, but how much debt is reasonable? And there's a lot of companies issuing debt, obviously, that aren't the best or most credit worthy overall, which is why there's different ratings in debt overall. So because of that composition is why, we'll see here in the following pages, is why it's so also easy to beat the benchmark in the fixed income marketplace, because it's not value driven like the equity segment, because it is driven by issuance, because there is such a bias toward government, that managers, just by taking very marginal amounts of credit risk in the corporate market and being decent in security selection, they can really make a good run and consistently beat the fixed income benchmark overall. So we see that on page 6, and we'll get into some of the performance in a little bit, but some of the managers we wanted to bring to you for consideration of this are, of course, Baird Core Plus Bond, which is on top. I would consider Baird a very traditional fixed income manager, excellent consistency, excellent confidence in the manager from across the industry there from the Baird team overall. So we've put that up and represented it as our top pick for traditional active management in the fixed income space in a mutual fund format, right? Different than your separate account format with Garcia Hamilton. And then we put together 2 passive options, right? The top passive options in the index space, Fidelity and Vanguard. Obviously much lower cost there with Fidelity and Vanguard. Baird comes in about 30 basis points, pretty similar to what you're paying today for Garcia Hamilton. The following pages have a lot of different quantitative statistics, and I'm happy to get into as much of the weeds as you'd like to, but I figured, we'll just jump straight to performance overall and look at brass tacks and look at results here. So page 9, we'll see trailing performance of Baird, Fidelity, Vanguard, Garcia, and the index. You see across the board, Baird Core Plus Bond has outperformed really top quartile or top third in all trailing time periods pretty consistently. And the rankings obviously show that, but look at the bottom where you have the rankings for the Barclays Ag, and you'll see that the Ag typically tends to rank toward the bottom. And above that, the Fidelity and Vanguard indexes also, because they're tracking that, tend to also lag toward the bottom of the peer group as well. So while you always know what you're getting and you'll always get the benchmark performance, you're getting it in the only part of the capital market, I believe, where active management does make sense. And for a very marginal fee for active management, access to credit, you can outperform the Barclays Ag pretty easily overall. On page 10, you kind of see that just on a calendar year basis, the consistency of Baird Core Plus Bond, 7 to 8 of those last trailing calendar year periods have outperformed the overall benchmark, and peer group, rank very highly in the peer group. Page 11 is one of my favorite graphics overall when you look at any kind of fund comparison. And this is the crosshairs, right, where you look at risk-adjusted return, risk and return plotted on a chart. The blue dot represents Baird Core Plus Bond. The yellow triangle is Garcia Hamilton. The other index funds obviously fall within the crosshairs, but you can see that for similar risk or just slightly more risk, you're really able to generate a lot of excess returns, 3-year, 5-year, 7-year, 10-year, by taking on some of that active just by taking on a little bit of credit risk. Baird has about 30 to 40% corporate bond holdings overall, some other securitized debt holdings, and then is underweight government, of course. So they've been very good at selecting managers consistently, and they avoid junk debt. Even though they have the ability to purchase junk bonds, they only have about 2% of the portfolio in junk bonds. So they do have very high standards and quality standards as well for security selection. We could keep going through the rest of the pages. They're kind of just going to reinforce the same thing about consistency and outperformance of Baird, but I'm happy to pause at least for a second and see if there's any questions.
Think on if we go to page 8, because there's always a reason when fixed income, when it outperforms the index, right? They've done something other than what the index has done. And if you go on to page 8, there's only so many levers you can pull in fixed income. There's duration, which is how long you're buying. So either they buy bonds that are longer than the index or shorter than the index, right? The other would be the sector allocation with these types of funds. Either they're overweight government bonds or corporate bonds, and then the other would be the credit quality. And so this is a snapshot in time, so I don't know what it's in the past, but if you go all the way down to the bottom of page 8, one of the reasons why I suspect that it's outperformed is if you look at the credit quality versus the Fidelity U.S. Bond Index and Vanguard. You can see those are very, very similar, just rounding errors, differences. But you can see what the index is. So it's outperformed the index because it has almost 30% of it. And, and still BBB is investment grade. And so I'm not saying it, but it's a lower quality investment grade. Therefore, it has a higher yield, which has caused it to outperform the index. And that works. And I'm indifferent to all of these, right? But that works because over the last, 10, 12 years, we've had a great economy. And you could have bought junk bonds, the lowest quality of the junk bonds in the last 10 years, and done absolutely fantastic because we haven't been in a recession. And if we go into a recession or we go into some troubles, then since you've pulled the lever towards lower quality, this fund will struggle and it'll immediately go from a top 10% fund to a bottom 10% since it's overweighted in lower quality. And again, we could be in a great economy for the next 10, 15 years from going on, and this fund could continue to outperform.
This question may be for Kerry, I guess, but it seems like historically, in this past couple of years, the bond portion of the overall portfolio is close to 30%. Has that been consistent for the past, say, 5 years?
I would say somewhat, yes.
Yeah.
Yes.
Okay. Now, of course, the obvious question is, the previous 5, it wasn't the 30%. Had it shifted? Are you anticipating another shift if the Fed should make a change? The Fed said they didn't do anything yesterday, but they're eventually going to have to cut their rates. So is that something you're looking at, making an adjustment on the overall percentages?
So I think, every couple of years we do look at an asset allocation study. I don't know that we would necessarily make any short-term moves over what the Fed may or may not do, because that seems like it's changing so much. But we definitely do look at the asset allocation every couple of years. I think the challenge is really at this point, you all are kind of just in, kind of stocks and bonds, so you're just kind of changing the allocations among those asset classes. But I mean, to your point, Jerry, it's probably been a couple years since we've done that, so very likely in the coming quarters we would do that. Yeah.
Obviously, I can't criticize your performance because it's done very, very well, but I was wondering if this is something you're looking to make an adjustment to as the Fed makes an adjustment to their rates, and looking forward, can we see it sneak down to, say, 25% or something like that?
Yeah, I mean, I think most kind of public pensions are in that kind of 20 to 25% range. I think the question is kind of where does it go? Do you do more in equity? again, I wouldn't make any changes near term, because if the Fed does cut, you should benefit from some of that from a pricing standpoint. But again, over the next couple quarters, just looking a little bit longer term, I think it could make sense to, always be taking a look at this on a regular basis.
Okay, thank you.
Sure.
Yeah, I agree with that. I mean, a cutting rate environment's going to help all fixed income holdings, junk, government, corporate, everything should benefit from a falling rate environment due to the duration aspect of it.
Is it normal for this is the only pension that that I sit on. Is it normal just to have all the funds and all your fixed income in one fund? Is that a common, I mean, do you have some pensions that say, okay, we're going to put some in the index, we're going to put some in the active, we're going to put some in a corporate bond fund? I mean, what happens?
You tend to see, so traditionally, for plans of this size, it's usually pretty simple. It's a traditional bond manager. Most of the times it's active because of the proclivity for them to outperform overall, but a lot of times it's split, just like they do in other segments where they have half active, half passive, and they tend to generally just stick to traditional core fixed income. Through the environment where we had zero rates for a long time, some decided to put in very small amounts of floating rate debt or something to that effect. And as we were in a rising rate environment, some added short-term debt, but it never really gets granular as to only corporates, only treasuries. They don't try to get too granular with it. Sometimes you get some short duration plays when you get to kind of extreme movements like we've had recently, or some floating rate debt when obviously things are at zero and you think, well, they have to go up from here, so what can benefit me in the fixed income space? Floating rate debt will do that, but even then it's very small allocations. But for the most part, it is very traditional.
Just have one fund manager.
Yeah, to one fund, or to your point, probably less. It's more common to see one fund, but it's not uncommon. It's seen in some places to have it paired up with an active fund also.
And with regards to it's the age-old saying in our world, which is past performance is no predictor of the future, right? So we can go back to a bond fund, and you can go back to Garcia and Hamilton, and it's really underperformed quite a while. But that doesn't mean that it's not going to be like the top performer going forward, right? Because if you look at, once again, on page 8, if you go all the way to Garcia and Hamilton, they're 100% in AAA government bonds.
Yeah.
They don't even have any very little in corporate bonds, and so that was the wrong move the last 5 years because the economy was great, and the more risk you took, the more return you got. If we went into a really bad recession or a down market, our Garcia and Hamilton fund would look fantastic with 100% in treasuries. So it's all. I guess what I'm trying to just educate everybody, it's all just really a flip of the coin.
Yeah.
Like there's no really way to know. Just because if something did poorly, now I'll argue for hours about equities that's different.
Oh yeah.
But in fixed income, we don't really know.
Yeah.
And that's why I was saying maybe we keep half in Garcia, and we put half in this, and we diversify a little bit. And I'm not a big fan of Garcia. I think they kind of but it's just because they bet wrong for the last 5 years. But their next 5 years could be the greatest fund ever. So, do you have any thoughts on how that works, or?
I'd like to point out, to your point, just to reinforce that, they make a lot of active bets, and on page 19, if you look at the bottom of page 19, I try to show that in some graphs, with their duration bets and their corporate bond debts. So bottom of page 19, you can see over time, Garcia's that yellow line, they make drastic changes in positioning to their duration portfolio over time. So they're making pretty active bets over time on what they think the market's going to do, particularly their, early 2022, right? They made a big bet and went really high up on duration, only to have rates continue to rise, right, and move against them overall. On a corporate bond side, look over to the right, as far back as 2020, they had 70% of the portfolio in corporate bonds. And they went all the way out of corporate bonds, and they can probably go into corporate bonds.
I was surprised to see that at 100%, in government. I don't remember them doing that.
No.
So they're very active managers.
Yeah. So lots of things that can go wrong timing-wise. You see that with PIMCO sometimes, right? PIMCO takes a lot of very active bets, and they can be wrong for some periods of time, and then they have a periods of really great performance because those bets finally played off. So I know this was a request from the last quarter. We bring this for information and discussion. Big believers in Baird. If you want to go active management, Baird's great. Obviously, the Vanguard and Fidelity are great if you want to add some passive. These are all great options. We can support all of them. But happy to hear any feedback from what the board is thinking or thoughts on Garcia, maybe splitting it. Do you get rid of all of them and do an index and Baird? I know, for me, honestly, and I know Garcia takes a lot of bets. They're a little bit too active, in my opinion. I would love to see something more like a Baird would be my preferential pick. If you're going to take active risk, take it with Baird. Don't take it with Garcia. If you want to offset it and hedge it with it. Add a third of your fixed income exposure, be indexed, 2/3 active with Baird. But Garcia is a little bit of a roller.
Yeah, that
coaster.
last page is quite an eye-opener.
Yeah.
Thanks for putting that in there. I didn't realize over time how they were making these changes. With the fund, with Baird, that's just your traditional mutual fund where it's going to be the fund fees, we won't have to pay them on a...
Yeah, you have to pay them. And that's another interesting for the structure, because it's a mutual fund. You don't have another separate account at Salem. So a little bit of cost savings there, even though Baird is technically 5 basis points more expensive than Garcia, because it's 30 against 25. But now you don't have the extra fees of having another account at your custodian from Garcia. There also is some, just to add another wrinkle.
What is the cost of that? What kind of savings is that, just like a basis point or two?
It's probably pretty small. I would say between a few $100s to $1,000 maybe a year.
All right.
And,
Go ahead, I didn't mean to interrupt you. Go ahead.
Yeah.
I'm sorry.
Just to add another wrinkle, because it is a separate account manager, because it is fixed income, selling Garcia isn't as easy like it is a mutual fund where you can just sell it. There's a process with that. Sometimes you have to hire a transition manager to make sure that we can liquidate those holdings and get really good execution for them. We actually have other clients in the pipeline that are liquidating Garcia. So if we decide that we want to liquidate Garcia, we can join up with them and we can get even better execution from liquidating those underlying holdings overall. But it's a little bit more of a process than just flipping a switch like it is with a mutual fund overall.
So we own individual securities? through-
Yeah.
Wow, I didn't know that.
Yeah.
Yeah, there
With
are
the-
physically treasury securities, mortgage-backed securities in an account.
Wow,
in
so
your
they're
name.
buying, on our behalf, they're buying individual securities
Yeah.
and then holding them?
Another reason why I kind of prefer the mutual fund structure. Just a lot more
Yeah.
checks and balances there, and just easier to have liquidity and transact.
So are we thinking about making a motion to make a change, or or just in a discussion? Information? You guys, do you guys even care? We're like splitting hairs, I understand that.
Yeah.
I think I didn't realize that about Garcia and Hamilton, so I think we should move out of Garcia and Hamilton. I didn't realize that last page really kind of was an eye-opener on how much they've been changing their bets over time. Seems like Baird is a little bit more of a stable company. The mutual fund structure is certainly better for us. The extra 5 basis points is inconsequential, really.
Yeah.
So, I mean, I would be happy either putting it all in Baird or putting half into, say, the Fidelity bond index or the Vanguard. I'm indifferent between the two. They're exactly the same.
Why are the fees for the index mutual funds so high? Where on the equity side, you can get 5 basis points or 6 basis points, and it's 30 a year?
Yeah.
Why is it so much more for
Or-
a bond index fund than a stock?
Or the bond index is lower. The bond index is 0.025 and 0.035.
Yeah,
I'm
0.0.
sorry.
Yeah, there's
actually
others
zero.
there. Yeah,
Okay,
yeah.
all right, yeah, I read it
2.5
wrong.
basis
I read it
points,
wrong.
yeah,
That is,
Oh, yeah.
that is a big difference.
Yeah.
Yeah.
So just to make sure I understand what you're saying,
Mhm.
you're talking about changing the active partner completely to go from Garcia to Baird.
That's correct.
And then another consideration after that is to diversify from active to take 50% or whatever else to balance into a
Yes, but I don't have a high conviction if, for
I
that.
just want to make sure I understood.
Yeah, I mean, I think it would be interesting to have both. The index is, I'm not, the SPIVA report shows us that it's better to be in indexes,
Yeah.
but, I mean, we're really talking about really small changes
Yeah.
in yield and performance. In equities, it's significant,
Yeah.
right? I mean, the underperformance on an equity standpoint, active is very pronounced and very significant, but with fixed income like this, there's not much of a difference. I do like the fact that it's a mutual fund structure, so I'm more favored of that than. But I'll leave it up to you. I don't have normally I'll fight tooth and nail, you know that about, on the stock side, but on the fixed
Yeah.
income side, I'm a little more indifferent, so I'll leave it up to the group on what they want to do. But I think we need to get out of Garcia and Hamilton, though.
How much money are we talking about?
6.6 million.
What percentage are you talking about?
It is
Well, 25% or so?
It's a little north
good
of
chunk
that. It was
Yeah.
about 27.
27%.
Your
Yeah.
so-called 31
It's a
bucks.
good chunk of the fund.
So it sounds like, Sam, what you want to do is terminate Garcia, give half of the proceeds to the Fidelity Index Fund and half of it to Baird.
Would you pick Fidelity or would you pick Vanguard?
I would pick Fidelity solely on the fact that it's just fractionally less expensive.
It's cheaper. Yeah, so I would make a motion? All right, so I'll make a motion that we exit Garcia and Hamilton and Associates, and we put 50% of the funds into Baird and 50% of the funds into Fidelity Management and Research.
Second motion.
Am I the only one, maybe because I've got a cold, am I the only one having trouble hearing him?
No, I have trouble hearing them too.
Good.
But I'm old.
Oh, okay.
You're mumbling.
I'm not speaking into the mic, and that's probably, so do you want me to make the motion again so you can hear?
I understood that motion, yeah, that's
Okay.
fine.
I wouldn't mind if you repeated it, I think I got it, but if
All right. So I'll make a motion that we exit Garcia and Hamilton and Associates, and we put 50% of the funds into the Baird Core Plus Bond Fund and 50% of the Fidelity US Bond Index Fund.
And that was a motion by Sam, second by Chris. Any discussion?
Do we know what the cost of getting out of Garcia is going to be, or can we estimate that?
It's going to be about 10 basis points is what we're thinking, because we're able to get some savings from
By
pairing it up with another client and some other clients that are getting out. And we might have some other clients that are also making the same decisions as we approach the end of the quarter, so that it might be 8 basis points or something in the high single digits, but something around that range, 8 to 10 basis points will probably be what it is. And we can firm up a liquidation date once we check with the transition manager. But it will be, what do you think, Harry, if you make this motion today, we'll probably get that done in the next month, right?
Yeah, I would agree with that. And then we probably would want a separate motion if they do a transition manager, which we would recommend. That's essentially a firm that comes in that specializes in trading. So they can kind of, sell off the treasuries and the mortgage-backed securities and buy, help us buy those funds at the most efficient way to do that.
Yeah.
And as Jorge said, the estimate is about 10 basis points. I actually have them working because I have another client making a similar transition. So they've seen the holdings, and they said 10 basis points is fair. As Jorge said, the bigger the size, the more favorable the pricing might be.
It's all treasuries, so I mean, it shouldn't be that
Yeah.
hard to,
Well, it's the mortgage-backed securities,
That's
it's the
the one that-
seasonality, how
Yeah.
seasoned they are,
Yeah.
and the size. But again, the bigger the pieces of the tranches we can sell, obviously, the more favorable the pricing would be.
Yeah.
But again, the estimate was about 10 basis points.
Let's do the first motion now, and then we can come back to the
Yeah.
transition.
so we have a second, so we, all in favor say aye?
All right.
Aye. All opposed say no, nay? That's a strange word.
Or zero.
4-0, thank you. Motion passes, and then you have another suggestion for a motion is to hire a transition manager?
You want to do it? You want me to do it?
Yeah, go
Since I
ahead.
inserted myself
Yeah.
into the process. Yeah, so we would recommend using a transition manager. I'm currently using a firm called Capus with another client that's terminating Garcia Hamilton and going to
We
two
use
different
Capus.
mutual funds.
Yeah.
I find them to be incredibly professional, helpful. They are the ones that gave us the 10 basis point estimate. So
Okay.
my recommendation would be to use
And I'm familiar with Kappas, I use
Again,
them.
we can get the scale because they're already working on liquidating some other Garcia Hamilton assets. The holdings are the same.
Okay, so we'll make a recommendation to hire a transition manager, which would be Kappas. Yeah. And I use Kappas, like, for our trust company, and
And
I'm
I
very
looked at
familiar
their
with them.
agreement, and it's fine.
Yeah, so I'll make a motion, or I'll make a motion, we need a second?
Second.
All in favor, say aye. Oh, you want to do discussion? Okay, anybody want to do a discuss? I thought we were discussing it. Is there any discussion? That be said, so all in favor, say aye. Aye. All opposed, say nay. So the motion is passed.
Thank you. We'll get to work on that. We'll get that over to you. I know, thank you for all the discussion there. I know we're talking about little bits of, and splitting hairs there, but I still think it's going to be a better structure for you going forward and give you some more flexibility in the future overall. I do have one more topic since we're already in the trend of making motions. We do have the organizational update to talk about. So recently, it was announced that ANCO is being acquired by a company called Mariner. Through this transaction, we are actually going to be rebranded as Mariner Institutional. Mariner is out of Kansas City. What they focus on is personal, wealth management, financial planning, tax strategies, small business valuations. So they're in a different marketplace than the institutional marketplace, which is what we do exclusively, right? Public pensions, 401ks, foundations, endowments. So we are essentially a new business unit of theirs called Mariner Institutional. From a regulatory standpoint, we will continue to be independent. We're just going through a name change, but we will have a shared parent company. Everything that's institutional will continue to go through our investment advisory firm. Everything that's still done on the personal wealth side will go through their traditional wealth investment advisory firm. All of our partners are remaining on, so Carrie and the rest of the partners will be partners in the new combined entity overall. So from what you'll see on your end is kind of the same thing you've seen through the previous evolutions, right? You've been longtime clients from Bogdan to ANCO. Now this is just ANCO to Mariner Institutional. A little bit of a different logo. The ampersand will be going away. I know people have very strong feelings about this ampersand, positive and negative overall, but that'll go away. The green color will go away. You'll get some different colors going on, different logos, but other than that, your team stays the same. All of your contract provisions stay the same, other than the name will be Mariner Institutional, other than ANCO. So as a result of that, there is a requirement for you to sign a consent letter, really just acknowledging the notification of the name change overall and the change of control. But so we do ask that the board make a motion to sign the consent letter and approve that, and I'll let Scott see if he has any comments as your attorney.
A couple of thoughts. Number one, he did a good job explaining what they're doing. So, I mean, essentially, our contract that we currently have with ANCO, we will still have with ANCO after this transition, because that entity, that corporate entity, ANCO Consulting LLC, that corporate entity is still going to be there. It's just going to have a different name, all right? So that's one thing, and the other is the change in control. The stock of ANCO or the new company is going to be owned by somebody else other than the principals in the current ANCO. So that being said, that's all fine. I would recommend that you approve the consent, remembering that contract that you have with them, just like the contract you have with everybody else. If it doesn't work out,
Yeah.
you can always terminate your contract with them, and we'll be able to do it in the future. That being said, with regard to the contract, I'm recommending to all the clients, and I have like 35 clients with them, so this isn't the first time we've discussed this. But I'm recommending to all my clients that they authorize me to do a new contract with the new entity. Over the years, we have a basic contract that we did with ANCO some time ago, and we've done addendums to the contract to add additional legal requirements as well as probably fee changes here and there. So we've got a number of documents that comprise that contract. I think it makes more sense to do a new contract with the new entity and make sure everything is in there. And I'm already working with their folks at ANCO to come up with a contract that's going to work for everybody on all their clients, at least the ones that I have. And I'd like you to authorize me to do a new contract for you as well as part of this consent.
All right, so we'll need to make a motion. The motion would be to sign the consent for assignment of investment advisory contract.
Yeah.
Right?
So we'll need I'll make a motion to do so. Does anybody want a second?
You want to add an and to that to authorize me to do a new
Well,
contract?
you want to do that as a separate one, or?
Well, you can do it in the same one.
Okay, and then
Authorize Scott.
authorize Scott to, go ahead and just say.
Authorize me to do a new contract with the new entity, Mariner Institutional.
Okay. So we
She's
need
got it.
to make a motion to approve.
I'll second.
Is there any discussion? All in favor, say aye.
Aye.
All opposed, say nay. Hearing no nays, the motion is approved.
That was Sam, you motion, Jerry second. Is that who got it?
I did.
Jim motion?
Jim did.
I seconded.
Oh, you did, okay. Sam motion.
Sam
Jim
moved.
second. Thank you.
He's a mover.
All right.
Perfect.
Is there any other thing, any other
That's it.
discussion?
I'm done. You don't have to hear me talk anymore. Sorry. Thank
We're
you.
both
I
done,
know.
yep.
Thank you for your time today. Thank you for acknowledging
Are you
that,
both
signing
gonna
the consent
continue
letter.
with us?
Oh, yeah, you get the same team.
Okay.
You'll continue. You'll still get me. You'll still get Carrie. You'll still get the same team out of the Winter Park, Florida office. We'll be servicing all the institutional relationships.
So we picked Jorge up a couple quarters ago. Every now and then I have a conflict and I'm here all day. He happens to be here for other plan meetings, so it's just super handy to have him kind of
Yeah.
join the team as well.
Yeah, It's better to have a team than
So,
it is an
yeah,
individual.
thank you.
so.
Thank you very much. He's excellent, so I'm glad he's here too. And I echo the thanks for the time.
All right, let's go to the second part of the reports. You're, Scott,
That's
Yeah.
me. All right, well, the first thing on the agenda is the summary plan description. Everyone remembers what this is. This is the little booklet that we have to update every 2 years and then distribute it to all the active members of the plan. So I've done it in strikes and underlines, so hopefully you had a chance to go through it and see what we're changing. There's not a lot of changes. The main change is the change that we had in the multiplier, and we put that obviously in the retirement section as well as the disability section. So that change is in there, and we did do a couple of changes having to do with, well, actually clarifications with regard to somebody who is in the share plan or has a share plan balance. They get their money, and then once they get their money from the share plan, they say they want to get their contributions back. And remember, we talked about this several times over the last year or so. They can't do that. Once they get benefits from the pension plan, they're no longer eligible to get their own contributions back, all right? The opposite is also true. Once they get their contributions back, they no longer have a share plan balance because that goes away. So this changes that I made to the summary plan description explain that, and hopefully it makes sense to everybody. All right? Let's see. Yeah, most of the changes, like I said, are the changes to the multiplier that we did. We always make a change to way back on page 10 on the maximum benefits. This is an IRS maximum amount that we're allowed to pay out to anybody in a given calendar year. You can see that the maximum went from $230,000 to $275,000 a year. We don't typically have a lot of police officers and firefighters that are banging up against that maximum, but we do keep up with it and put it in there. So, and probably the last thing is over on page 12, and this has to do with, you may or may not be aware that police officers and firefighters who retire under normal retirement or disability retirement actually can get a credit against their taxes for up to $3,000 a year in health insurance premiums. But in order to do that under the previous law, you had to arrange, and we actually have forms and everything to do this, you had to arrange to have your premiums for your health insurance paid for by the fund. In other words, we the fund, had to write the checks and send it to the insurance company. You couldn't do it yourself and get the credit. That has changed with the Secure Act 2.0 that we had last year. That has changed, and now you don't have to go through the plan. You can get that credit directly if you're paying the premiums. All right, so that's a change, and I put that in there and reworded that section so that anybody who wants to take advantage of that can, and they probably should. So certainly any retiree should take advantage.
Where is that covered?
It's on page 12, item 12. And then, of course, the list of the Board of Trustees' names are all the same, and we have the Exhibit B, which is the actuarial information attached. So, do you have any questions about that, Chris?
No.
Okay. If anybody wants to make a motion to approve the revised summary plan description, that might be in order.
It's a minor thing, but maybe write Samuel Kibbers instead of Sam.
Second.
Sam is my nickname, so it's not
That's
necessarily.
probably what I've had in there for the last 3 or 4 times.
Yeah, I just noticed it. I don't think I've ever got that far back.
Happy to change that if you want me to.
Yeah, I don't think it's a big deal, but.
What about in the minutes? I think I'm using Sam in the minutes. You want me to go, and I think I was using Samuel, and I just got comfortable, and it's Sam, so
I don't, does it really matter?
We don't know who this Samuel
I'm asking
person
you,
There's no such thing as, there's no person named Sam Kibbers, it's Samuel Kibbers, right? So is it,
is. Does this identify who the trustee is? Sam? It's up to you,
don't know.
Sam. If you want Samuel, I will change it to Samuel.
same.
sure,
Okay.
Sure what?
sure, change it to Samuel.
Change it to Samuel. Okay.
Yeah,
Good enough.
yes, please.
Anybody want to move to approve the summary plan description with the change in Sam's name?
I'll move the approval,
Where does Sam live? On South Tamiami Trail?
along with all of us.
Yeah, we all live,
We all live in Sam.
The reason I do that,
That's a group home, Jerry.
I use that address rather than your home address because you probably don't want your home address out there. And the police officers, by law, we don't post or
Yeah, I can
or publish their home addresses. So I use the same address for everybody.
And where is,
What's
1410
1410 South
Tamiami?
Tamiami? What is that?
where is that?
that's the police
Is that the police
station, isn't it?
department?
Yes.
Yeah.
Yeah. Oh, yeah, that's right. We met there a little while ago. Yeah.
Yeah.
That's
So
where
we're
we have
sending this in a false
a
address.
special meeting.
Well, it's not false, so they can get in touch with them there.
Okay.
I'll second the motion.
Any further discussion?
No further discussion. All in favor, say aye. Aye. All those opposed, say nay. With no nays, the motion is passed.
Okay, that takes care of the summary plan description. Let's see, next item I've got is the Form 1, the financial disclosure form changes. I think I gave you a heads up on this at the last meeting and told you that the state was proposing to move to an online portal for purposes of filing your financial disclosure forms, your Form 1. Again, they're not changing when you have to file it, so July 1st is still the date that you have to file by. But now you will not be getting anything from the supervisor elections, or will not be filing with the supervisor elections. You'll be going online, and you'll be setting up an account in your name, and then you'll put in your information, and then you'll know that you filed, and you won't
I
have
think
to
I did that last
get
year,
it
didn't I?
stamped by the supervisor of elections to prove you filed it and what have you. You'll get an acknowledgement right away. So, and there's some information, you may want to talk about what's otherwise available, but I think there's a little video when you get on there and you say you're a filer, you can watch a little video that tells you, how to do it. I've had a number of people that have already done it and said it's very easy, so.
I think I've done it, it's really easy.
Through the portal?
Yeah.
Okay.
Yeah.
So, but anyway, that's the way we're going to be doing it this year and going forward.
You're going to send it on an email? Is she going to send out an email?
Send what?
Okay, Chrissy is.
Yes, of
To do this.
Oh, yeah, okay. Yeah, but I did do a memo that you should have gotten that gave you where to go for that's probably how you. got
That's
it.
how I did it, yeah, I just figured I'd do it, get it over with.
All right, so that's the Form 1 memo. Next item is legislation. You probably are aware that the Florida legislature finished up their session this year, I think either last Friday or Friday before. We didn't have any changes to Chapter 185, and I'm always happy to hear that, because, when the legislature starts fooling around with 185, we never know what's going to happen. We do have so basically, we don't have any pension changes that need to be made, but a couple of things. Number one, they changed the law with respect to, as you're aware, probably currently, that police officers, their personal information, where they live and their telephone numbers and their kids and, a lot of personal information is not subject to public disclosure. If somebody asks for that from Chris, then we don't give it out, okay? They have added to the list of folks whose information is not subject to public disclosure certain veterans, okay, military veterans. okay? It's veterans who have either a secret or top secret, what do you call it?
Clears.
Clearance, yeah. And also, any military person who was involved in a special operations group, like the Rangers or the Green Berets or the SEALs and those kind of people. And in order for us to have to keep that information protected, they actually would have to come to us and request it and prove to us that they meet those requirements, okay? For the most part, though, in our plant, everybody's a police officer as well, and they already have this protection, so this is probably not going to affect us. But if you hear about it, it's going to apply to others as well. And like I said this morning, when I first saw that, I thought, why are they doing that? I don't understand that. But in the legislation, the last paragraph explains the fact that apparently terrorist groups make lists of these kinds of people.
Sure.
And so then it made sense to me that we protect that information. So anyway.
There's got to be a deadline on that regarding the number of years, because it's going to say, yes, I was heavily involved in that, but that was 25 years ago.
Yeah, and there is a, what do they call it, a sunset provision in there, so they look at some of those provisions every so many years to see if they want to continue it, but that one they may want to continue. All right, let me see, we took care of ANCO's consent. Other than that, the only thing I have is the news that I provided to you through a letter indicating that I'm proposing to, no, I'm not proposing.
That's an option.
I've decided to retire come August 1st. I have indicated to you and recommended to you that you consider one of the other, well, probably the other biggest firm in the state that does this kind of pension work. There are not a lot of firms that do this kind of work around the state. But Klausner, Kaufman, Jensen, and Levinson is the name of the firm. They have 7 or 8 lawyers that do nothing but pension work, okay? They have 4 senior partners, and then they have a number of associates. One of the associates, Blanca Greenwood, Blanca is currently doing about 5 plans. One of the reasons I went to their firm is because they have the manpower or lady power to take over the 48 clients that I have, okay? And so I'm proposing, and I send all the names of the clients and their schedules to their firm so that they can make sure that your schedule and the meetings that are already scheduled by you can be accommodated by these lawyers. So Blanca would be able to come to your meeting. I'm suggesting her for the general plan earlier today that I also represent. So she would be the one that would be doing the representation of your plan if you approve it. I'm proposing that we invite her to the next meeting so that you all can meet her, ask questions, and become comfortable with my suggestion. Now, as I also said in my letter, you don't have to take my suggestion if you don't want to. You can go out for a request for proposal, but I can tell you, this is the 4th and final time that I'm doing transitions. You may remember that my partner Lee Diener, who passed away, at one time we had 160 clients and we were doing about 80 each. We downsized once, and then when Lee passed away, obviously I had to downsize again because I couldn't do all his clients and all my clients too. So I downsized again, and then a couple of years ago I further downsized, kind of bringing the clients all closer. That's why I still am representing you. One of the reasons I'm still representing you guys. But that being the case, when I did this before and did the transition, I made recommendations to all my clients, and I think maybe of the well over 100 clients that we transitioned, maybe 2 went out for proposals, and most of the other clients basically said, Scott, if you're comfortable with this and you're recommending that, it's good enough for us. You don't have to feel that way if you don't want to, but I think this will work out well for you, and I want to make sure. I got a couple other things I want to tell you. Number 1, Debbie McCord. You may not know that name, but Debbie McCord is my assistant. Debbie's been with me off and on for 30 years. She actually worked for us for a long time, over 10 years. She moved to Colorado. She was there for 10 years. She moved back here, and she came back to work for us. So she's been working with me for a long time. And this lady is super smart. I always say this tongue in cheek, but I kind of mean it. She knows this business so well that if she had a law degree, I'm convinced she could do my job. Okay, she can't do it, but she could, I think. So, because she's an assistant who, I don't just give her a piece of paper and say, type this up, okay? She looks at it and says, now why are we doing this? And what's the law behind this? And that's what she's done for years. And as a result of that, that's how she's learned all the background and the stuff that we do. So why am I telling you that? Debbie is going to Mr. Klausner's firm as part of this transition, and she's gonna have a full-time job with them. She's gonna be still up in Bradenton. She's gonna work from home. But when Chrissy calls, she's gonna get Debbie. She's gonna get somebody that she knows at the other end of the line. So I think that is a huge factor in this transition issue. Not only that, I am going to remain, and you may not know what this term means, I'm gonna remain of counsel with the Klausner firm. So what that means is I'm not gonna be out going to meetings and doing everyday work, but I'm gonna be associated with them sort of like a consultant, for want of a better term, which means that if something comes up, I mean, I've got a lot of history up here that may not even be in the paperwork I'm turning over to them. So if something comes up and they need to ask me something, I'm part of the group, and I'll be there and available to answer questions and help with projects and what have you. So I think all of those factors hopefully make you comfortable that this transition makes sense. Also, one of the things you may be thinking is, Scott, your fee is pretty high, your hourly rate is pretty high. My hourly rate is pretty high because I've got 35 years of experience in this area, right? But so when I get asked a question, typically I can give the answer off the top of my head, because there's very few things that have happened that I haven't come in contact with over all those years. But Blanca is an associate with this firm, and she doesn't have nearly the experience I have, so I'm already talking with them about offering you a lower hourly rate for her services, because obviously she don't have 35 years of experience. So we'll have that and be able to present that to you at the next meeting. So unless you have an objection, I'll invite her to the next meeting, and you all can ask her questions and hopefully get comfortable with that, with the transition, and then we'll do it.
Do we need to make a motion?
You
For
can
this?
do it now if you want to, but
I think we ought to wait and meet the young lady first.
Okay.
Old lady, I don't know how old she is.
I think she's young.
Young, okay.
Well, anybody's young to me, but
Yeah.
With this big, I
passed
got a quick question for you. With this big pitch you have on the Klausner firm and Debbie,
32.
what kind of kickback percentage-wise do you get?
32 years of practice.
I'm kidding.
Later to me.
Yeah, compared to him.
I am going to be on council, so
I
I
know
will
you
be.
are. I know you are.
Will you be at the next meeting then with her? Is that
I'll be
what-
here.
Okay,
Yeah,
one
I'll
more
be here
meeting
to
and then,
introduce her, and you can ask questions of me and her.
okay.
And we hire the law firm,
Yes,
the board does?
the board does, yeah.
Okay.
You have a contract with me, and what's going to happen and what you're going to approve is
I understand.
is an
that.
assignment of
I
my
just wanted to-
contract to them. So then
That would
they
be at the
will
next
your
meeting,
lawyer. And remember, my contract again says you can fire me anytime you want, and if they're working under my contract, they have the same provision. So if you transition it to her, to their firm, and you don't like what they're doing for you, you can terminate them and get somebody else.
She's got a really strong police background, that's for sure.
Yep, yeah, she did.
So we don't need any motions at this point?
You don't, no, I don't think you want to make a decision yet. I'd recommend you meet her and, get any other questions answered.
You know, are we going to make a motion on the retirement?
I don't know.
If you'd get a
I
second,
hate to tell you this, but you have no jurisdiction in that area.
That was a thought.
No
we get
authority.
a second.
I tell you, this is really hard for me. I mean, every time I do this, the transition, well, obviously this time, I said this morning I was pulling the plug, and I probably shouldn't use that term, but this is really, I mean, it's kind of bittersweet. I mean, I got a lot of friends in all these places, and all the fine people that I work with, and it's gonna be hard for me. But only so much tennis and woodworking I can do to stay busy, so I'm gonna have to find
You
something
live in
else.
Fort Myers?
I live in Sarasota.
Sarasota, the other way, okay.
Bradenton.
Scott, what year did Lee pass away?
18, March of 2018. It's been a while,
Yeah.
yeah.
All right, so yeah, invite her to the next meeting.
I will do it. Actually, she's already signed up to come.
Okay, well, good. All right, moving on, is there, do you have anything else, or?
No, sir, that's
Okay,
it.
so,
That's
do we have
all.
any old business anybody wants to bring up? If not, we'll move on to the consent agenda. We need the payment ratification of warrants 44 and number 45. Which,
I have a question about these. We approve a lot of money, obviously, every meeting. Is there somebody that goes over these to verify the charges?
Oh, yes.
Okay, so you-
Absolutely. So we have a dedicated, we have a dedicated billing coordinator at Foster and Foster. Literally, all she does is invoices. She does create internal invoices for our division, but she also receives all the vendor invoices. She audits them against the contract that is in effect, make sure that everything's, good. And then that, before the warrant goes to Salem Trust for payment, goes to another person on staff to just review and make sure all the numbers are adding up, that they're correct, nothing's been transposed. So yes, they are reviewed. And then I put
Dylan
my.
has to sign them too, doesn't he? Doesn't Dylan
Yes, this is a
authorize?
two-signature, so in
Yeah.
addition to them being reviewed internally, then it goes over to Dylan, he signs it, and then it goes to Salem Trust.
I bet Dylan doesn't spend as much time going over as they do.
Probably, no.
What caught my eye was the $10,000 report charge on this one.
Which page is that
For
on?
Foster and Foster.
Page 44.
That's the actuary. Is that for the
The
valuation?
Valuation report.
Yep, the
Oh,
valuation
yeah.
report. Yep, that's their big ticket item every year.
Yeah.
Can I ask you a question you mentioned
Oh,
earlier when
$10,000.
the legislature's not in session right now, and they start messing with 185. What is 185?
Chapter 185 is the chapter that deals with police officer pension plans.
Okay.
So
But
in other
not-
words, we have to comply with the minimum requirements of chapter 185 in order to get that state money that we talk about every year. We get that money in August, and so that's the chapter that we have to refer to. Kind of gives us general guidelines.
And the police, and I'm making the assumption then that the fire department has a
They have a 175.
175.
Right.
Okay, just
Yep,
thought I'd ask.
yep. And both chapters are very similar.
Right, okay.
All right, do we need to make a motion to approve payment ratifications? So, anybody want to make a motion to approve?
We're making a motion to do what?
To,
Approve the consent agenda.
Oh, yeah, I'll make a motion we approve the consent agenda.
Second.
is there any further discussion? All in favor, say aye.
Aye.
Aye. All opposed, say nay. Hearing no nays, the motion is approved.
All right.
Right.
It's like
Staff
very
reports?
Triumphant music right now. Yes, sir. I really don't have much to discuss, except for the educational opportunities that are forthcoming, one of which is a virtual program, and it's free. If you want to watch, I think it's a class, maybe just a short video, about the new financial disclosure form requirements. You certainly can do that, and I'm happy to register you myself, but it is free, so if you want to just log into the FPPTA and sign yourself up, you can absolutely do that. Sam already filed his, and he said it's pretty easy, so the course may not be necessary, but certainly if you're interested, it is available. And then the annual conference is coming up in June. I will be there standing at a booth, smiling and waving all day, so if you go, please stop and say hello. And of course, if you do want to go to the conference or any travel, trustee, education, whatever, just please contact Foster and Foster, and we will get you registered and pay the fee, so you don't have to worry about that out-of-pocket expense. And from there, we'll go over all the travel and reimbursement procedures. So just keep us posted with anything you want to do, and that's all I have today.
And that's in Orlando.
Yes.
Oh, there it is, right there, I'm sorry.
And the annual conference doesn't have classes like the schools do, but they usually have some pretty good speakers. And there's booths, you can walk around and see different vendors, and there's little giveaways, and it's fun. It's social, mostly, not as educational as the schools, but certainly not a waste of time.
Schmoozing.
It's exhausting, is what it is. Oh. And that concludes my section, so guess we're on to trustee reports, discussion, and action.
Is there any trustee reports, discussion, or actions?
Anybody have anything?
Anything else before we adjourn? Motion to adjourn, I forget. Make motion to adjourn? Second?
Second.
Any further discussion? No. Is there, all in favor, say aye.
Aye.
All opposed, say nay. No.
Nay, I don't want this meeting.
You want to keep it going?
I'm just kidding, I'm not.
With no,
We
with
get
no
overtime at
nays,
some point.
the motion is passed, and we are officially adjourned. Thank you for coming, everybody, and we'll see everybody in 3 months.
Good job, Sam.
Yeah, you did well. And there it is.
You're a natural,
Yeah, it's not my thing.
the next king,
Yeah,
King Sam. Samuel.
Samuel now.
Yeah,